Today, Governor Lowe and the Reserve Board met and they kept the cash rate on hold at 1%. Now, that's obviously on the back of two rate cuts that we saw in June and July, which took the cash rate down to 1%. So the consensus is that we needed to see some time to see what impact those two particular rate cuts have had in terms of confidence, sentiment, and what's going to flow through to actual numbers. But also don't forget we had the tax stimulus that's also been put in there. So more on that, because we do believe that the cash rate could go as low as 0.5% as early as February next year. So I'll talk more about that as we go through this presentation. Now, in terms of globally, I want to start globally. Now, obviously the biggest game in town at the moment has been the trade tensions between the US and China and trying to get that right. Well, there's obviously lots of gamesmanship that is going on in that space, and that is definitely affecting global tensions around confidence also and sentiment in the broader economic story around the globe. And that's led to obviously some revisions in terms of global growth across not only obviously the US and China, but also right across most developed nations. Now, that also led the Reserve in the US to cut. So after a tightening cycle, they actually cut their cash rate down by 25 basis points last week. And so their band now is 2.2 to 2.25%. So, what was interesting about Jerome Powell's commentary there, which was, most commentators wanted to see more dovish commentary around further corrections in their monetary policy. But the reality has been that Powell basically surprised the market a little bit by sort of saying it was a bit of an insurance policy cut, not necessarily a sign of a deeper, sort of correction cycle or easing cycle. So that did surprise the market. Now, he did also clarify that there may be one more to come, but I thought most people were thinking that they're going to see the US cash rate drop even more substantially. So one, that's a vote of confidence in terms of how well the US economy is performing. But, again, it's an insurance policy really about what's happening in terms of the global trade and how that's affecting sentiment. Now, we've seen the US equity markets performing very, very strongly on the back of that easing, and I'll talk more about the Australian equities market later. But that is obviously one of the big news stories that's not going away anytime soon. The other is Brexit. So we now have a new Prime Minister of the United Kingdom in Boris Johnson. And what has been interesting about Boris Johnson is that he's saying, hell or high water, come 31st of October, we are exiting the European Union. So he's saying deal or no deal, which could lead to obviously, again, a lot of brinkmanship up until that point, but he's telling his people that is it. So there may not be a deal, and that's interesting really, because what's going to happen to Ireland? Because they wanted effectively, a backdoor stop for Ireland. Well, this could be, and this is early. It's an early call, but will the United Kingdom be around, or will we be back to Britain and different parts of the United Kingdom? So lots to play out there in the politics in the United Kingdom. And that uncertainty also impacts economic activity and investment. And that's what we don't need in terms of growing the global economy. And finally, we've also seen the developing story in Hong Kong that's been playing out over the last month in terms of the democratic protests that are going on over there. And those protests are continuing. And so, hopefully China doesn't use a heavy hand with those protesters, because again, some strong arm tactics is also going to cause some tensions around what that means for Hong Kong being a financial hub and what's going to happen in terms of that market. So China, please, keep your powder dry. Don't do anything silly in regards to that. But those global tensions are obviously problematic in terms of global growth. Let's swing our attentions back here to the Australian market, and what is very clear, and I'll continue to keep repeating this for those who haven't really, the penny hasn't dropped, is it's very clear that the RBA are going after the labour market, right? Now, they are going after a lower unemployment rate. In their view, they need the unemployment rate at 4.5%. Now, 4.5% they believe is going to be a trigger for higher wage growth. So wages growth and sustainable wages growth. We saw what happened in the US where they got their unemployment rate down, I think to as low as 4%. We have seen wages growth start to materialise during that time. But under the gig economy, it's getting harder and harder. So the RBA are going after that number. So that doesn't mean that they're worried about the broader economy. They'd certainly like to see it growing stronger. And they'd certainly like to see the government of the day, being the Liberal government, doing more in terms of fiscal policy. But we know the politics in Australia right now is the Liberal Party are going after their surplus. They want that surplus in terms of this financial year. So I don't think we'll see any fiscal stimulus until they hit that surplus. And if they hit that surplus, then we'll see in the next May budget probably some more fiscal stimulus to support the monetary policy easing that's going on by the RBA right now. So that is a big story. So in terms of inflation, we'll just get to some of those numbers. So, going after that low unemployment rate means also that if we do get wages growth, we would normally see that flow through to inflation. Now, there was an important speech made by Governor Lowe this past month, which did talk about why they want to continue to keep the 2 to 3% target range in terms of their forecasting or their mandate. They believe in terms of that would maintain the credibility, and that would also mean that they could anchor their decision making around that 2 to 3%. So, and in broad terms, if the economy is growing and inflation is growing at 2 to 3%, usually the economy is doing well, and that means better employment and better living conditions for those people in our fine country. So coming back to inflation data that was released for the June quarter, we saw a 0.6% increase, which was higher than market expectations of a 0.5 increase. That took the annual rate of inflation to 1.6% for the June quarter, annualised. Now, some big numbers in there. Really, when you started to think about it, there were sort of three big things that played out there. Fuel up 10.2%. Medical was also higher than expected. And the Australian dollar also meant that we had international travel inflation. It was costing us more to go overseas. So they were the main triggers. But the underlying inflation is still very, very soft. And again, that's why the RBA need to do something about that. Now, we did talk about the labour market. Let's look at the numbers for the past month. Unemployment rate was pretty much flat at 5.2%. We only grew new jobs by 500. Now, we have had some strong jobs growth over the past 3 or 4 months, but still not a good number, and that would be, concerning for the RBA in regards to that. Job ads, which was a positive, rose by 4.6%, but we've got to remember the May job ads was down significantly, so that was a bit of a recovery of what was a poor number there. Business confidence, so we're moving through inflation. We've obviously then talked about the labour market. Now, business confidence, this is the one in terms of, remember, a lot of this data is lag data, so some of these confidence things is also about leading indicators as well. So positive story here in terms of business confidence went from a -1 in the March quarter to a +6 in the June quarter. Now that means that, broadly speaking, people are feeling a little bit more confident post-election in the business side of it. That still doesn't mean that that confidence is actually materialising into activity yet. And so that is something that we just need to keep an eye on. But the ship is hopefully turning in the right direction and gathering steam. In terms of credit growth, this is, again, some fascinating numbers around credit. What credit means is people have got confidence and they're investing. So housing credit growth in June was up +0.2 of 1%. Business was only up 0.1 of 1%. So that's still not where it needs to be. And personal credit growth was actually -0.2 of 1%. So annualised credit growth is sitting at 3.3%, which is the slowest pace since September of 2013. So I'll tell you this story, right? Credit growth peaked in this current cycle at 6.6% in 2015. In 2016, it had dropped to 5.6%. In 2017, it had dropped to 4.8%. And in 2018, it had dropped to 4.3%. And I just read out what the current rate, which is 3.3%, which is the lowest since September of 2013. So, again, they are lagging indicators, but ultimately if business confidence is moving and sentiment's improving, hopefully that will see us gathering some momentum. In terms of the housing markets, we have seen a significant decline in terms of medium and high density construction. That's off in terms of new forward bookings of around 60%. So high density is definitely on the nose at the moment. The positive news story for housing was CoreLogic's dwelling price index was released, and we did see in terms of the July result for the 8 capital cities saw a modest 0.1% growth story. So that means we've effectively bottomed out, and that's been the best reading since August of 2017. Now that's on the back of, obviously, a couple of rate cuts, an election result which was probably more pro-property. We're now seeing APRA make their changes and they're easing in terms of their macro-prudential interference in the marketplace. So borrowing power should improve. So we really do think that we're probably calling the bottom of the market over the course of this July, August, September period, which was effectively what I was saying, post-election, that I did think that we would bottom out in that sort of August, September period. So that's positive news for us. We turn our attentions now to the consumer. So consumer sentiment, this was a little bit of a disappointing result, to be honest with you. That fell, from 100.7 in June to 96.5 in July. And so, ultimately I'd like to see that bounce a little bit now that most people are starting to get access to their $1,080 for the low and middle income earners. So I think that's an important story. The retail spending, and I think this is why the RBA did keep the rate on hold today, and also why I suspect that September will probably be a hold figure. Now, if we see an unemployment figure that is surprising on the downside, on the negative, then they may pull the trigger as early as next month for another 25 basis points. But my view, along with most economists, is that it'll probably be October or November before we see further easing to get the economy moving quicker. So retail spending, this was effectively a flat result. So it's a bit lagged, so it's not the latest month, so it's still May data in terms of retail spending, so it takes them a little bit longer to crunch the numbers. So in May it was plus 0.1%. Now that was after a decline in April where it was a negative 0.1% fall. Annualised, we're looking at 2.4%. Which is the weakest since January of 2018. So more work to be done there, and that is one of those indicators that I'd like to see improving. The problem is it's a lagging indicator, so that's why it takes a while to see that positive numbers flow through. In regards to some other highlights, the equity markets, well, naturally what we are seeing here in the Australian equity markets, we've hit our highest point in 11 years. We've reached a record high, and this is going back before the GFC, which was our last record high for the ASX 200, and that happened last week. Now, why is that happening? It's really simple. Okay, so the cost of money goes down, so depositors can't get a good return in keeping their money in the bank. So they've got to look for better places to put that money, where they are going to get a better return than literally nothing in an at-call savings account or less than 1 to 2%. It's not worthy, whereas they could potentially in the equity markets obviously get some dividends, distributions, those types of things, as well as some price growth. So the cost of money goes down, asset values go up, which means that share prices are usually revalued. So we are seeing a flow of capital into the equity markets with this view that interest rates are going to stay lower for longer and are going to keep deteriorating. So we might see this particular run in the Australian stock market continue on for some time until we have some clarity around what's happening in the broader economy. In terms of closing out this month's message, I want to talk about the borrowing side of the story. So there's still a lot of attractive fixed rates that are starting to be promoted by the banks at the moment. My view on those fixed rates is steer clear of them. No need to fix your rates. Variable rates are going to be your better call at the moment if the rates are going to continue to keep falling. So, we talked about a potential rate cut, which will be another 25 basis points in October, and even a further cut that could happen in February of next year, which will bring the cash rate down to 1%. Why is that the case? Well, again, if the federal government isn't going to do anything around fiscal stimulus, unfortunately, the RBA is going to be doing most of the heavy lifting. Now, property prices improving. We're not going to see a run on property prices. I don't think we're going to see a huge bounce in property prices. What we will see, though, is in some of the better areas which have probably had more volatility, those prices will probably bounce back really quickly. But in terms of the broader property market around Australia, we'll probably see more steady and sustainable price growth as opposed to, rapidly increasing property prices, which we saw in the earlier part of this easing cycle. So my message is back to you with fixed rates. I would only be fixing rates if you have uncertainty around your financial position, but I would be taking advantage of the variable rate. That's not to say that the lenders are going to pass on the full rate reduction from the cash rate. That's not going to happen. They've still got to keep some margin for profitability. So even though the cash rate might fall another 50 basis points, we may only see the lenders passing on as little as sort of 25 to 35 basis points of that. And I know that doesn't sound great, but ultimately they've also got to consider their depositors in terms of how they're raising money, and also keep their margins of profitability to keep them strong and viable. So interesting times ahead. We'll definitely have to wait and see what comes out of the unemployment data. That's our big indicator in terms of whether we'll see a rate cut in September or whether we're going to be waiting till October or November. Thanks for watching this month's update, and we'll speak to you next month.